All right. So, there's a lot going on in markets, and I can sit here and, wax poetic about the Fed this and the administration that and the war this and, all that. But I think those of you who have been with us for a while probably know by now i- it's nice chatter. It makes for great discussion. It's obviously a lot of it vitally important to the world we live in and the way our lives go. But as an investor, where sometimes you have to be kind of cold-hearted and simply say, okay, like there's not a whole lot that matters outside of this ever increasing trend toward the market being one market. It goes up, it goes down, and so much crowds together. In fact, just got a note from my awesome editors over at Bar Chart, and they said, "Could you do a little bit more on?" I wrote an article called "Straight Talk," but it was spelled, like Strait of Hormuz, and apparently it says like my most popular article on that platform so far. And they said, "Can you do more on oil?" And I said, "Yeah." Part of it is, and this would probably be the next one there, that it's like a hurricane. The oil trade and what's happening to the price of oil, kind of like with uh, 10-year, 30-year treasury bonds not long ago, what was happening with AI stocks, in particular, NVIDIA and Mag 7. The market gloms onto one thing, but more and more, I feel like it's all come together to the point where simplicity is going to win and win and win again. Simplicity does not necessarily mean, it definitely doesn't mean S&P and chill, um, because there's a lot of risk in that. But there is a sense that I have that you can trade anything. But if you're trying to set up a portfolio, which is really, really what we're going to focus on today, how do you construct a portfolio without my agenda? Everybody will personalize this themselves. In fact, if somebody wants to be a volunteer, happy to have you kind of walk us through it. I'm going to show you how to use um, the Roar.podtrade site because I'm on it like all day now. It's not just my playground; it's my research tool, and I'd love to make that a habit. Um, for everybody in this group. Um, and we're here to help you figure out how to use it as well. So, look, the markets are quite binary. It's been that way for a while. Um, it can be as few as two ETFs. It could probably be as many as I don't know, 10 or 12. Um, and stock picking is fine for trading, or if you have an extremely long time horizon. Um, and you'll see in the weekly roar that just came out here, the focus here, and I'll just spend another minute on this because I think when you come to the weekly, or if you listen on the replay, obviously you can throw all kinds of questions at me. If you've read this, it just came out a few minutes ago, but uh, alpha, beta, and capture. Okay, just so you know, the part that is the paywall starts kind of where the good stuff starts. Okay, like right about here. We are doing that because we're at the point where, look, I mean, this is getting pretty serious. You're either going to be a risk manager and you're going to be okay no matter what happens in the markets, or you're going to get caught in the way people invested money 10, 20 years ago and just assume that everything's always going to work out if you give it enough time. And I'm here to tell you that even in this century, we have lived through a period of 12, almost 13 years in which the S&P 500 made no money, including dividends. So yeah, I don't sit here and predict. All I am doing is trying to make people aware there's a very wide range of possible outcomes. And the best thing you can do as an investor is you can shrink it down to control it what you want. We all get to choose. Believe it or not, the markets, they may be this inanimate object, but we all get to choose up to a certain point with a high degree of probability, I think, what our best case and worst case scenario is. The only thing you can't do is say, well, my best case is I average 50% a year for a decade, and my worst case is I never lose. That's not what I mean. I'm talking about being able to say, all right, if I want more upside, I can get more upside. I may have to take a little more risk of downside. But there comes a point because the tools are there now. Okay, ETFs, options, bond ladders, you know, tactical rotation among stocks and ETFs. You can shrink that range, but you can shrink the lower end of it much more so that you avoid the floor dropping out on you, and you can up this a little bit. And that is kind of my verbal summary of what you'll read today in the weekly Roar, what I call my ABC of investing. Everybody's out there looking for alpha, okay? There's even a major site that I write for that that has it in its name. Everybody's looking for alpha. At least they think they are. But the way they're going about it is all they're doing is they're chasing beta. Something looks good in past performance. Oh, the market went up 15 last year, but this one went up 22. I think I'll buy that. Absolutely the worst approach to investing that somebody could take. Not because it won't work for a while, but because when it stops working, you will have absolutely no clue as to what to do and what went wrong. And what we are about entirely here is helping people to learn. First we teach, and then you teach yourself, and you'll see me do it and kind of lead by example today. We're trying to transfer this 40 years of knowledge I have from being a practitioner and managing money professionally on big stages and small alike, and try to take that, package it up into enough insight that you can take it in and then really create your own approach to being your own portfolio manager, which, by the way, doesn't mean that you have to do it all yourself. And I'm going to introduce somebody in just a second who is helping make it so that my portfolios, some of them anyway, my premium ones, if you will, Roar 10 ETF, et cetera, that if you want to track it, you can track it and you'll see what's in it. Okay, and we'll update it each week. But then if you want it done for you, at a fairly reasonable price, even if it's just to say, oh, okay, I see what's going on in that portfolio. Now let me figure out based on that. It's almost like a hybrid between a researcher and a portfolio. That's all I'm really going to say about that for the moment. But it ties in so closely with this ABC of investing. What is ABC? Well, we're all looking for alpha. Okay. Alpha is not, oh, the market went up and, I caught the market. Okay. You could be up 90% in a year, but if that's what the market did, you didn't generate any alpha. All you did was what the market allowed you to do. And this has been easy if the S&P is your benchmark. Spy and chill. But I believe that one of two things is happening right now. Either that era is just over, dead, gone, or it's taking a break and it's highly unpredictable and we do not know. It's more likely the first, but I'm not going to sit here and try to, gamble on that outcome. Either way, I just don't think that is going to be business as usual the way it's been for the last 15, 16 years. And that's why, frankly, as in one of the video posts we just put out the other day, that's why I'm still working and semi-retired and not declaring myself fully retired, because I think that this is a very important moment in the market cycle, and frankly in the investment lives of probably anybody who's between 40 years old and much older. And the older you are and the closer you are to retirement or in retirement or in semi-retirement, uh, the more it's going to matter. And I just do not think that in particular the boomers are prepared for this. I've been saying this for a long time, and we're starting to see the cracks now. And ask anybody who has invested in, let's say, the average S&P stock instead of the index fund, which is weighted toward the top, 10, 20 companies. If you've owned the average stock for the last few years, you really haven't made much money. I mean, you're going on like 4 years of almost nothing. Um, but that doesn't get a lot of publicity, and we're all just getting stuff jammed into our phones all day. And so it makes us think that this is the right path, when in fact the right path was right in front of us, but nobody was talking about it, and so very few people took it. Okay, no more metaphors, Rob. So that's alpha. Beta is what everybody's getting right now. Okay, the mood swings, the market goes up 10. Oh, I'm up 17. I'm crushing it. Great. Well, you have to assume that the more you're making on the way up versus the market, you're going to lose just that much on the downside. If not, then you're producing alpha. If market goes up 10, then goes down 10, and I've had this a million times in my career because my style is conservative that way, managing risk first. The market goes up 10, I go up, I don't know, 7, okay? Market goes down 10, goes right back to where it was, and I go down 3. Well, I made 7, I lost 3, I'm plus 4. Whereas the market has come back to 0. That might be the simplest definition I can give you of how you produce alpha, and do it by managing risk. You get 7 out of the ups, even 3, 4 of the downs, and the market goes nowhere, which it can do for years at a time. Well, you just keep cashing in on the net 0, if you will. And there's a lot of ways to do that, but you have to start out with a plan, not an investment plan, not a financial plan, not a fiduciary plan, because I'm not a fiduciary, but some idea of how you want to plan your portfolio, and we'll get to that momentarily. So, beta is just the up and down. It doesn't get you anywhere unless the market goes up forever. And last I checked, I think that's in serious danger. And what I just explained to you was capture ratio. If I capture, I don't know, 2/3 of the ups and 1/3 of the downs in a flat market, I'm going to be up. Well, that's good, because I don't want to have to turn to my family and say, the market didn't do very well, so, no vacation this year. Okay. Um, Back when I was working full time and managing other people's money, we're a little more upperly mobile, if you will. That was the type of thing. It's like, okay, if the market doesn't help us, can we help ourselves? That's really what alpha is. And so focus on generating alpha through capturing a good chunk of the ups. Doesn't have to be nearly all. You can try, okay, but not that much of the downs. Uh, Play offense, defense at the same time. Avoid big loss, ABL, risk management. All my favorite buzzwords. Okay. Um, all right. You can read the rest of that all you like, and look forward to your comments, questions on it. I am going to go to here in a second, but first, and I don't intend to make her the star of the show because she's here more listening in today. But if it's possible, I would like to introduce you just for a moment to Priyanka Ranjan. Priya, are you around?
Yeah. Hey, Rob. How are you?
Oh,
Hey,
great,
everyone.
great. Well, yeah, you can go video or audio only, whatever you like this time around. I
Yeah.
know you're kind of sitting in with us this time. Um, Priya is one half of an absolutely dynamic team that, I mean, frankly, has extended my career happily. I mean, I'm not just going to be kind of trading myself and writing a few articles because um, she is one of the co-founders of PieTrade, uh, and she's listened to these before, but she's never joined us live. So it's a great time to do this. Uh, and while PieTrade is and this won't be a PieTrade commercial, but just for those of you who don't realize, PieTrade is a copy trading platform where you can say, okay, Rob's portfolio is a bunch of other people. I click a couple of buttons. They're a registered investment advisor firm, RIA. Um, Interactive Brokers is the custodian, the brokerage, and you can take different people's portfolios, including mine, and go in, click a button, and you can have your account tied to it, and it does all the trades for you. Um, that was their original business, and I think they were doing just fine trying to grow that as an early stage, fintech company. Started what did you start about a year and a half ago?
Yeah, but we launched in like 3 months back.
Ah, got it. Okay, yeah. So really new. Um, and to finish this brief introduction, um, how did Roar.PyTrade come to be? Because you and your co-founder Harshit were I don't think maybe we're thinking about a research analytical arm that could also feed into the PyTrade app, but it wasn't top of mind, was it?
Yes, I think Rob, I would say after meeting you, I think we got into this research idea as well because this whole road thing that you had, like it could be translated into a platform, which was not the initial idea of ByteTrade. So yeah.
Yep, yep. And I think it's fair to say we're moving at the speed of light or the speed of sound, whichever one's faster. Um,
Light sound is slow.
there you go. Yeah, I guess that would make sense.
Yeah.
Folks far more educated than I. Okay, no offense to my alma mater, but I'm a SUNY Albany grad and a Rutgers MBA. Okay, uh, so anyway, good. I mean, anything else you want to just tell folks before I start to demonstrate this, and feel free, obviously, while I kind of teach portfolio construction one-on-one today. If there's anything else, but yeah, anything else you like to tell them just about?
Yeah. I just wanted to tell one thing to everyone. So, when I say copy trading, I don't want to just say it a copy trading platform. And the reason being is like I have this background of like quant investment strategy and portfolio management. And this is what I'm trying to build for retail investors. Now, Rob is like a portfolio manager itself. Like he's not personally managing someone's money, but whenever he's trading, everyone else is who is copying the trades will be like the trades will happen together. The good part of what we are building, because of the technology, all the trades are executed together at the same price. So the concept is not like, oh, my trades are not executed at the same price as Rob's, or this is not what we are doing. So all together as one block trade at one average price, like we average it out so that there is no disadvantage for copying a trade.
So they're literally, I mean, obviously, I have an account there for each of the strategies that I trade, and when I trade it, it's traded as a unit, almost like an ETF, I guess.
Exactly. We are building an ETF for the system that is possible now. which is not, which never existed. And one
Yeah.
thing also is like you can trade on your own as well. So right now what happens, we need not to think like, oh, if I'm copying Rob's portfolio only, I have to be on PyTrade. No, you can trade on your own as well. And we don't charge anything. Even interactive prices are one of the best. So like even the execution fills will be very good. So
Yeah.
that is also
And so right now it's very much in kind of spread the word, try it out. I wouldn't call it beta test mode because it's real money and real
yeah,
accounts and all that. And obviously, Interactive Brokers very solid
yeah,
backing. Um, but at this point, yeah, I mean, for a newer business like this, you guys have been working on it for a while, and your backgrounds are terrific. Um, the hardest part in today's world is kind of like Steve Jobs said, people don't know what they want until you show it to them, right? They have to find it.
exactly, exactly.
Yeah.
I would not call now beta testing because we have already completed everything. Only if there is some new features we are releasing, or like now, if you face any problem, I'll be always happy to like I'll reply personally to everyone
Mhm.
if there is any issues. So that's all.
Yeah, you've done a phenomenal job. Just because we have people who've gone over and started to use the system. I mean, many people who are using the rural research system, and yeah, there's definitely some people that have already kind of been the first movers on this, and I think so far so good. And it's great because look, with both of these systems, okay, Roar is a research system. It's my Roar score with lots of stuff built around it and the ability to create your own portfolios. I mean, a year ago, if you'd said to me that this would be available, I'd be like, no blanking way. Because we had tried for so long to do so. I mean, those of you who've been with us for several years, I tried everything, spreadsheets and whatever. I was so excited so many times, but then when PyTrade came along, it really came to life. And so these two divisions, if you will, the one that is the advisor, registered advisor, the PyTrade, and the research site, roar.pytrade.com, meld pretty well together. And frankly, the third leg of the stool, as they say, is etfyourself.com because so much of my best thinking and my ongoing research is now being housed there, plus a lot of the educational stuff. So, all right, Priya, thank you, and please do stay with us.
Yeah.
Um, and I'm going to do this. I mean, look, Um, I can take it, and I see I have one question here, which I'll get to in a moment. But and then once I do, I'm going to give you a quick little market tour, and then I'm going to do a little portfolio building here. But I've spent so much time on this stuff that not just now, my whole career. I used to say, people would ask, "What business are you in?" I'm in the construction business. Oh, okay. What kind of buildings do you build? No, I build portfolios. So to have a tool like this and be able to be in the construction business for real is actually pretty cool. So, uh, but while I'm walking you through just a quick review of the markets, of which a little piece was in the weekly today, as I'm doing this, if you have a portfolio you'd like to use, it doesn't even matter what's in it, but it's always easier for me. And I'm working on a few things myself, but rather than walk you through all that, um, start with something maybe simple, and somebody on this call can get something out of it. And remember, this is free to use. Okay, you just go here, you get you put your email in, and you get a login and the usual song and dance, and then poof, you come up right here. Let me just answer the question from Teresa first. How often do you readjust the positions to maintain the ROAR allocations? If an ETF goes up 15%, you reduce that position to match the goal Just trying to understand. Exciting product. Yeah, isn't it? So I will say this. It's actually, and she has kept her. If you're keeping score at home, okay, Teresa has this habit of always asking a question that is like right where I'm going. It's uncanny at this point. Okay. Um, so really the question she's asking is once you set up a portfolio and you're your own DIY portfolio manager, once it's set up, well, what do you do next? And that is part of the portfolio management process. You start with where I'm going to start here. It's like, okay, what are we trying to do? And I'll get to that in a second. But after it's built, you then have to have rules, guidelines, a discipline about what's going to prompt the change. And typically, the common ones are it could be based on time, okay? And for those of you who say market timing, time in the market, not market timing, what does every 401k do? Okay. Or what does every pension do? Okay. Oh, every quarter I'm going to rebalance the portfolio. I'm going to rebalance the ETF once a quarter. Why once a quarter? That's a timing move. You just decided it's once a quarter. In our portfolios, at least the premium ones that we've set up over on PieTrade, the every Wednesday morning, like tomorrow morning, good example, okay, I will take the Roar scores, which we just got from tonight, okay, and I'll even walk you through some of that. Yes, Penny, you can put an IRA in PieTrade, just like any other brokerage. Sorry, I saw that question. It was a quick one. Okay, my IRA is going in there, or at least a chunk of it. So if once you have a portfolio set up, okay, we're doing weekly. Now, it doesn't have to be any set period of time, but Wednesday mornings I will get the Roar scores for my main list. In fact, I'll show you because it's right here. All right. So, yeah, this is the main one. All right. These are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There they are. Here are the 10. And you can sort them. You can sort them by Roar score. You can sort them by what their percent change was. I was kind of mystified until the head programmer and co-founder explained to me, this is built on AWS, Amazon Web Services, and it's so much more advanced in terms of these systems that might look the same, but were built even like 5, 10 years ago. So like the stuff, like literally you could give us an enhancement request and I mean, you might be surprised if we say, okay, that makes sense. We can go and do it. So we're happy to build this with particularly this group, our kind of inner circle here. So anyway, the one thing that jumps out at me here, okay, is that TBF has gone to an 80. All right. So again, quick review of the Roar score. The it ranges all the way up to 100. Bill is 100 because this is answering the question, what's the risk of major loss? The higher the number, the lower the perceived risk of major loss. There's never a guarantee. Okay. But so, generally speaking, okay, it's not a buy or sell hold signal per se, but if I'm going to say, all right, I would like to buy the Qs, and it's got a 20 Roar score as it has for a while. The Qs are at a 20, SPY's at a 20, and DIA is at a 20. All three have been at a 20 for about a week. Okay. Is this a timing system? It works well as a timing system, but if you count on it being a timing system every single time being right, you're going to be very disappointed because markets don't work that way. A lot of things, get extended very quickly, and it's like, oh, gee, I just bought it and already it's oversold. I mean, that's happening in markets. Just look at oil, look at gold recently, right? Look at crypto sometimes. Um, anyway, I will look at these again more formally tomorrow morning, and then I will look at the position ranges that I have set for this portfolio, which are very specific to each one. As an example, just because I have these 10, okay, and here I'm going to sort of do a little different. It looks like there may be some like aftermarket pricing going on here, Sarah, because the scores are not changing, but the order is changing. There we go. Okay. So, gold, uh, it's these scores are not telling anybody what to do. They're telling you one additional piece of information that I dare say not a single person on Wall Street has, because I created it, and then Pietrade made it happen. So that every stock and every ETF pretty much on the U.S. markets every day during the day is updated. That's the power of this. And fortunately, the scores are not flipping back and forth constantly, but they'll slide around a little bit. So automating portfolios with this is great, but everything we're doing is what I would call semi-automated. Tomorrow morning, I will get all these scores. I will double check them. I will look at the charts myself because I'm still the portfolio manager of that. Okay. Not for any individual investor because I'm not a fiduciary and it's not personal advice. But I will do it at the model level and for my portfolio. And so I'll look at it and it will basically say, okay, you're going to want gold to be at the lower end of your range. Well, gold is a little different from the Dow. Okay. I don't mind owning the Dow in some size, 30%, something like that. And I always want to own at least a little of all 10 of these. That's how I operate as a portfolio manager. Why? Because I've seen too many cases where, case in point, gold recently, where all of a sudden, out of nowhere, it goes from it's in the dumps with no reasonable chance from a technical standpoint of bouncing, and then something happens, a news event, something, and poof, gold's up 20% in 2 weeks, off to the races. Things get better, money comes in, because the markets are all about liquidity flows and buying and selling pressure. The Fed and the war and all the other stuff, they play a role, but at the end of the day, it's what people decide, especially big money people, decide to do with the funds. So I'll look at this tomorrow, and these are all going to be probably downplayed in the portfolio. I'm not trying to decide, am I in or out of the NASDAQ? Okay, that's the stock picking crap that I just got tired of and decided we were not going to create another one of those when we start ETF yourself. So, look, there's a lot of this here, okay? And this is a little market picture at the same time. All right, cash is always honored because, really what this is saying is how much risk of major loss are you taking? Well, as they say, gosh forbid, okay, that the T-bill market becomes entirely unreliable and that you don't know what the value is every day. Okay, it's 100 because we're going to assume that the value, is going to stay stable. Okay. The other way we put it, sort of anecdotally, is what's the next 10 to 15% move? Is it going to be up or down? Well, I would say there's just about 100% chance that the next 10% to 15% move in a T-bill ETF is going to be up and not down. It may take multiple years to get there, but it's going to happen. The only other ones that look kind of interesting to me here, just kind of use this as, because obviously this is a portfolio that's already built. I'm just showing you the components here, not the weightings, because that's kind of the other part of it. TBF is at 80. Okay. And I know because I'm tracking this every day that it just got there. Okay. And this is the other way to track these. So, and again, this is where we could use a lot of feedback because, I mean, we can pump out plenty of information on these things. The question is, how much is information overload? We also realize that, and just so you know, these are weeklies, okay? Right, Teresa, you're asking about before. Every week, I am reviewing all these and making these trades. There are other portfolios that I am creating right now, a couple of them, where every day will be live. Okay. Now, technically, every day could be live with this ROAR 10 ETF, but I do not. We want to have something that is a little more close to automated. And this is certainly it's a kind of conservative to moderate risk portfolio. It doesn't need to make every single day live, especially because I selected these 10 after lots of research, days in the short run, but years of watching, decades of watching, okay? Only these 10 because I think they work very well together, whereas most portfolios today do not work well together. You own the same thing 5 or 10 times and you think you're diversified. I cannot tell you how many times. And again, it's big rule portfolio management. Don't collect investments. It's, collect baseball cards, okay? Collect coins, collect stamps, collect, what do you call it? Russian nesting dolls, okay? Uh, don't collect investments. In other words, don't go and say, I own this covered call ETF and this one and this one and this one. Or, well, I'm very diversified because I own the SP 500. I own the NASDAQ. Pretty correlated. Okay. Not the Dow and the NASDAQ, a little bit less. Dow and the NASDAQ, the SP and the NASDAQ. Yeah. Oh, and I also own this great growth fund and I own the Cathie Wood thing and I own, whatever. And it's like, guess what? All up and down together. Okay. And it won't make you feel good when you say, hey, wait a minute. I have 10 ETFs and they're all going down day after day in this bear market, if it turns into that. And the only difference is which ones are down 5% for the month and which ones are down 10 or 15% for the month. I put something out on this recently. So take a look at that article. All right. So there's a couple things working together here. Portfolio management, it doesn't start with what should I buy? Okay. And I'm going to get to that here. Let me see here. Actually, and just to finish my little run there on and just kind of wrap it together on Teresa's question. Okay. If an ETF goes up 15% quickly, well, are you rebalancing, or I should say, not rebalancing? How often do you want things to be live? When are you willing to make decisions? Some people say, I don't want to bother with it constantly. I'm going to look at it once a month. I'm going to look at it every 2 weeks. I'm going to look at it every 2 weeks or any day where the market goes up or down 2% because maybe something's changing. You set your own rules, and I'm here to at least help you learn how to think like a portfolio manager. That's why I'm here. So, something may change in the allocation it is in the portfolio, but you have rules for that. Now, one of the rules can be if something gets too big in the portfolio compared to what you want. I'll give you an example. Okay. I am okay with the NASDAQ, the Qs here. Generally speaking, it's going to be 10% of the portfolio, it's going to be 20% of the portfolio, it's going to be 30% of the portfolio. With the ROAR score here, it's going to be 10. Okay? Because a lower ROAR score, red as a meaning high risk. Look, NASDAQ could go up 10% in the next 2 days. Okay? I gauge that there's roughly speaking about a 20% chance that it's going to have a major move up and an 80% chance it's going to have a major move down next. But that is also a work in progress. And that's why I don't want anybody taking this so literally. If you automate it, you put a portfolio together, you can look at the back tested results and we'll show you that. But you see, hey, this is not a good look. But at the same time, it's easy to get faked out because again, markets are volatile. Okay, mid-December, it was a little bit of a shakeout. Okay, and we're thinking of ways to try to make this system. We think it's quite user friendly, but I think it can be more user friendly, and that's why having more users will help us make it more friendly, if you will. Um, so look, I mean, this was a year ago when the market was cratering, and yeah, it was right on that. Why? Because the technical pattern was so obvious. I mean, at the time, if you were in the group, I was walking you through this whole thing, okay, and the results showed. I was doing a lot of collaring, things like that, because anything I owned at the time a year ago, like it was going to be hedged. Um, and then eventually, okay, but we have to get out of this mode of is it a buy or is it a sell? Oh, it was a sell, now it's a buy. Okay. Portfolio management is about doing things incrementally and going back to this, I have 10 different levers that I can pull. You don't always need 10. And by the way, the stocks can be levers too. I'm working on one. It's a little tougher to model than I thought, but I'm working on a model right now that takes the Dow 30 and says I'm always going to own all 30, but based on Roar scores, uh, and maybe on a weekly basis, we'll see. Maybe it's live every day, but uh, I'm going to overweight the ones that have the better Roar scores, and I'm going to underweight the ones that have the weaker Roar scores. So I'm messing around with it in a lot of different ways, but that's what you can do in this system. Okay, so I want to move off of this. I think I've given you a bit of a market review here just by saying, hey, it's early, it just happened, but the thing that I am watching, especially as a guy who owns a big fat bond ladder um, in zero coupon treasuries, um, you know, we have had a lot of indecision here. I go to the last 6 months. A lot of indecision. See, this is color coded. This is the price chart of TBF. Okay. Here is just price. It'll tell you if it's price or if it includes the dividend yield as well. But you can see once you get to read this, okay, it was kind of waffling around for a while and then finally got itself in gear from a 40 10 days ago, here from a 20 days ago, when I was starting to think, okay, TBF is probably going to sink. That's the same thing as TLT going up, which means rates are going down and bond prices are going up. This shorts the 20 to 30-year treasury. So this is like if inflation spikes rates and trashes bond prices, this ETF is one of my best friends. That's why it's in the 10 portfolio, not because I necessarily loved it a month ago or 6 months ago, but there's going to come a time where there's very few ETFs that can do what this can do. Yes, there are levered versions of this as well, and I'm messing around with that in the system as well to see if I can control that and get a little more juice out of the return. So what happened with TBF? Well, interest rates all of a sudden started to edge up, 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 up. And what happens here? As rates go up, TBF goes up, looks more attractive. It was priced, way down here in the 23s. Again, it's bonds, so it doesn't move that much, and it's not including the yield in here. We're going to some places it does, some it doesn't. We're going to try to make it so it's in here all the time. But anyway, it's had a gradual lift here, and during that time, I mean, yeah, with perfect hindsight, I wish I would have bought it here. Okay, but technical analysis is different. It's not like saying, okay, it's fairly valued here. All right. If this were a stock and you said, oh, I think it's fairly valued here or it's undervalued here, I'm going to buy it here. This is what you see on TV all the time. It drives me insane. Okay, buy the dip, Buy the dip, buy the dip. It's breaking out. Buy the dip, buy the dip, buy the dip, buy the dip, buy the dip. Buy the dip. Look how smart I am. Like it's a game. And uh what we have tried to build and the way I've always looked at markets is first, can I lose big? Second, are you sure I can't lose big? And then keep going up from there. And the way this system was built, because this is basically me mapping 40 years of charting onto this with an absolutely brilliant programming team, making it come to life in a way I never could. But this, is trying to decide, and there's all kinds of inputs that go into there. Okay, all kinds of market inputs, but at the end of the day, it's how money is moving. You want to say it's sell America trade, which I think is kind of overplayed. You want to simply say it's a higher inflation. It's money getting pulled out by the Japanese to put into their bonds, which are much higher yielding than they have been. There's a million different reasons. None of these things matter to me, folks. All that matters to me is that I can buy low and sell high. Okay. And if I do buy low, that I don't end up small losses. I don't care. I'm running a lot of these things, and it comes back and says to me, your win rate is 40%, but I produced a lot of alpha with very little volatility. So I don't care if I'm constantly tossing out small losses. It's not everybody's style, but that's my style. I'd love to have a high winning percentage, but at the end of the day, all I want to do is not lose big and then make as much as I can. So I just gave you a quick and dirty review of how I think like a portfolio manager. And by the way, once again, this is what's great about working with these guys and this modern technology. I knew these enhancements were coming. They're here. We whittle this down to the ones that we think are most effective, and I'm kind of replenishing this list. Again, for right now, you got this over here, okay? Enter a portfolio amount, choose a portfolio. Here, I'll show you using one of these sort of curated ones that I created and they programmed. Okay, select your benchmark, create your portfolio. So if you want to start out simply, all right, let's put a little more money in there. Okay, it doesn't really matter. All right, it's $100,000 investment, and I'm going to my classic SPY bill. Okay, this is a really nice look here. So if I click on this here, okay, and actually looks like some of the some of the stuff that was here before has been taken away, but this is good. I see a lot of these enhancements. So I go and I run this, and I guess it's running versus a standard benchmark. I have to see here. Let me just check here. Can I customize the benchmark? Yes, but these are the done for you portfolios. Okay, I got it now. See, the changes happen so quickly. I know they're coming, but then when they hit, I'm like, oh, what's that? Okay, so here, all right. Now this is kind of a tough competition, but the portfolio wins anyway. This is for those of you who've been with us, like since the beginning of ETF yourself, beginning of 2022, I believe. I was delivering that weekly ROAR score every week, changed up the formula a little bit, make it a little bit more all weather. But the SPY bill thing I've been doing for years. Now, it is a risk managed portfolio, and so its actual benchmark is probably AOM, which is the moderate risk benchmark. This is AOR, which is 60/40, kind of a growthier portfolio. But I think it's interesting to note, okay, you can see here, you started with 1,000 in this case, and then you had COVID hit, and the 1,000 in this portfolio, which again can only have stocks and cash, okay, it had a 10% drawdown, but it didn't have what I guess is about a 17, 18% drawdown that the stock bond portfolio did. They both recovered, et cetera. And if we want to look at this, hey, I think this is a pretty good view of it. I'm just showing you the analytics here. So this is the year so far, and again, not the best fit benchmark, as we would say, but it just goes to show, okay, a portfolio starts out and obviously it's sensing a lot of risk. The Roar score is very sort of in the middle for SPY, so there's a decent amount of money going to cash. As you can see, that has changed. Okay, all this is doing, and again, anybody can do this. I think you can even copy trade it. So, you can, at this point, SPY, the Roar score of SPY is 20. The way this one happens to work is whatever the Roar score for SPY is, that's the allocation to SPY, elements of portfolio management. So I've decided how many ETFs am I going to have? 2. I'm going to have one to play offense and one to play defense. In most portfolios that you build on here, you really just list all of them, and then you cash is the fill-in, okay? Because there's going to be times when you build a portfolio that has, I don't know, let's say 4 ETFs, and maybe they're all equity ETFs, and the market's not very good, and they're all saying, take a low weighting, take a low weighting, okay? That's the other part of portfolio management. You pick what you want to consider. That's your watch list. Then you decide, do I want to own at least a little bit of everything at all times, or do I want to make it so it can be a zero position? That's what I'll finish up with here in a couple minutes. But I want to complete the simple example here because I'm sure we'll do more of this next week based on your feedback. So, the market starts falling here, and stocks are going down, and bonds are going down, and all of a sudden, this thing is ahead of the game. It's been, I guess, really here the last month here. Okay, so to me, this is proactive risk management, and frankly, I have one hand tied behind my back here because I can't short the market. I can only go to cash. Being able to profit from a down market other than T-bill interest, it takes some learning, but I'm here to teach it. And, that really is the way this goes. So look, and I don't mind telling you, okay, the 2 ETF, the 10 ETF portfolio, this looks, let's see, no, actually, yeah. This one has slipped a little bit this year. But as you can see, it's holding its value a lot better because it's got that small equity position, okay? I'm going to do some simple analytics here, and then we'll move on to creating a bigger one. Okay, and here. So this is just the past month. You go back to here and you see we did this all the way back to the beginning of 2020. Rob, why not before the beginning of 2020? What about 2019? What about the dot-com bubble? Mostly irrelevant except for historical rhyming in my book. Why? No algorithmic trading back then the way you have it today. Indexation, everybody was just SPY and chill or S&P and chill. Okay. There's just so many market mechanisms now that are automated, and they create all this whippiness to the point where everything's one big trade up and down. It doesn't mean that you don't stop looking for alpha generators, but they're hard to find. And look, every week I get more convinced that let's say if all I had done since the beginning of the pandemic, so you're talking 6 years and 3 months now, if all I had done was looked at the Roar score for SPY once a week, just like I used to do in the earlier version of the newsletter, okay? What's the Roar score? Oh, it's 20. Good. I'm at 20% SPY and the rest goes to Bill. How much is the rest? Well, it's got to be 80 because I only have 100%. So 2080 this week, Next week, it could be something different. And that's all this is doing. Once a week, two ETFs, and it doesn't have to be these two, as you'll see. It can be any two. It can be any five. It can be any 55. It can be stocks. It can be ETFs. It's like we realized when we released this on y'all that it might be a little overwhelming, okay? But that we're now moving into the portion of the era, if you will, of SunGarden ETF for self and pie trade, where now we're trying to, on a regular basis, well, good. Rob's happy to hold court and teach people how to use this because then you can figure out, okay, how much of me is ardent do-it-yourselfer? How much of me do I maybe want some help with? How much of it do I really just want to, off to the portfolio modeling, somebody else does it kind of thing? And that in itself is an asset allocation decision. Okay. Good example from my own portfolio. The biggest part of my portfolio is not something that I'm expecting to go live with every day and trade. It's zero coupon treasuries. Starting about 5 years, going about 20 years. I make adjustments to it and this and that, and I hedge it using options and I hedge it using inverse ETFs. But that's an allocation decision I made that my single biggest liquid asset was going to be that bond ladder because I want money coming due every year. That's just me. But that's what I'm saying. It's no different than somebody saying, hey, that's a part of my portfolio I decided I do not want to be in the markets every single day. That is the closest I get to set it and forget it because I'm going to get X dollars on X date every year like this, like a second pension. I've written about this a bit. I can refer you to the articles if you like. So you come back to this, and again, not really a fair fight, okay, because this is a more aggressive portfolio, but check this out. So even against the mighty 60-40 portfolio, doing very little work, by the way, because we've done the work. You're just putting it on autopilot in this case, or you're adjusting it. Or maybe you're writing covered call options or buying puts on your SPY position. That's the thing. These are models, okay? And yes, you can replicate the model every trade and copy it, but you can also use all this plus the premium models, which are a little more sophisticated, 10 ETF on all that. You can use these however you like. And while I can't tell you as a non-fiduciary what to do with them, I can help you think through so that you can decide what to do with them. That is the phase we have now officially moved into here in terms of our research, especially for the folks that tend to attend these calls. If you're in the premium Substack, then you're in the inner circle. You're in the club, so to speak. Okay. So anyway, you look back over 6 years and 3 months. It actually beat AOR. It averaged the devil 6.66666, right? Okay. Hope that's not a bad omen. Okay. AOR, a little bit less. Okay. The maximum drawdown was 14% versus 23. Not bad. I mean, if there were a hedge in here, see, you could take this, simply figure out some type of disaster hedge to add in that would go up when the market goes down. Now you've taken it to the next level of portfolio management. This is what I mean when I say it's like sort of the cat's out of the bag here, and there's no one right way to do it. But if you want to follow my lead, now you can do that to whatever extent you want. It could be as a learning device. It could be because, some of it's getting too tough. It doesn't matter. It's that hybrid approach. Let's see here. Sharpe ratio. I mean, I don't want to get too wonky, but Sharpe ratio is return per unit of risk, which is kind of like a good test for the Rohr score, right? What it means is for the risk you're taking, how much return are you getting? It's really a relative number. And this is about 50% higher bang for the buck, if you will. Now, the Sortino, then the AOR, which again is kind of an unfair comparison. I got to run this against AOM, and you'll see. Um, Now, a Sortino ratio is the same idea, except it really focuses primarily on the downside. Because as they say, there's no such thing like we don't mind volatility, right? If the market's going up. If the market's going up and we're more volatile than the market on the way up, well, that's good. We're making more money. We only care about volatility on the way down. And that's what Mr. Sortino came along and said, hey, Bill Sharp, I like your work, but I think I'll go a little bit further. Okay. Um, I have created effectively my own sort of version of this with the Roar score. And hopefully one day it will be sitting up there in the databases with the Sharp and the Sortino. But you can see pretty significant advantage here. Okay. It's about 1.6 to 1. Okay. All that means is this portfolio, this simple portfolio that does nothing but SPY and cash, with the Roar score mechanism, that's the key. What is your active mechanism? It doesn't have to be Roar. Okay. So what's a portfolio? Offense, one or more securities. Defense, one or more securities. And a system or process or discipline that can be consistently applied no matter what and unemotionally to take the offense and the defense and figure out how much of each to play at each time, if it's a very simple portfolio, or if it's the big daddy here, the 10 ETF portfolio, then it's how much of each of these to play. Okay. And as you know, we are in a bit of transition here because of the newsletter and this. Okay. This page that you're looking at right here, okay, if you're watching the video, you'll see it this week, whatever, okay? This is really like behind the paywall kind of stuff because first of all, I won't make the decisions final until tomorrow on this, but since this is kind of like the main portfolio, this is my old core portfolio from when I managed money for, for families and 3 billion at one point. I mean, it all kind of descended from a portfolio that was kind of like this. Certainly not exactly like it, but it was in the same spirit. Offense, defense, rotation. But I was eyeballing the charts instead of having the Roar analyst alongside me. So what we want to figure out, and I think that Priya and her team have just about done this, so we'll let you know when they do. But we want to make it so that if you are, we're not making this available for the 150 basic level of Substack. The 600 level, yes, and anybody who works with us in a soon-to-be created sort of hybrid user package where it's like you're do-it-yourselfer and you can do some yourself, you can do some with my research, you can do some by having PiTrade, the RIA, supervise it with Interactive Brokers and all that stuff. I mean, it's you'll see more on that, but we're not quite there yet. So this is what it looks like, but this is Tuesday night. Okay, I am going to give this a once over tomorrow. Definitely not going to do it on the fly here. Okay, so for instance, I'm going to look at this TBF and say, TBF, it's telling me based on that Roar score going up this week in this Wednesday morning turn that I'm going to do. And I say Wednesday morning, but I give myself the right to make the changes anytime Wednesday, because who knows how crazy a Wednesday or any day could be now. So you see, they're all owned at all times. This is Roar 10. And these are not the positions that I put on last week. I mean, they might be if none of the scores have changed, but this is updating every single day, intraday. This is like the live up to the minute version. Okay. The Qs and the DIA have both been a 10 for a little while because the reward scores are low. The gold, by the way, I wrote this in the newsletter this week. Gold was teetering on going lower, in my view. So I actually overwrote my own Roar score because Roar is a bit of a smooth calculation. And I could see, any day now, there's a decent chance gold is going to be something I'm going to want to get out of the way of. So I brought it to the minimum position of 2 instead of 5. Well, gold went down like 6, 7% in the next couple of days or something. You know, some luck, some skill, but the point is I am managing the portfolio with some intention. I didn't just say gold, let me see. Okay? No. What's the Roar score for gold? It's in the red zone. That drives me to the lower part of this. Okay? And so I'm de-emphasizing gold. Not to mention, gold is at least a sliver of this commodities index. Okay? This is the lowest that IWC can be. So all three equities, the lowest equity exposure I can have between these three right here is 22%. What do I have right now? 22%. Why don't I just let it go to zero? If you want to do that, you can do it. You can make it so it's never less than 90 if you want. These are all little constraints that you can build yourself with this system. And it's all available right now. Um, so to me, I always want to have some why. Well, because I haven't got to the defense yet. Okay. And actually, thank you guys for putting this in this kind of order. I don't know if it stays that way all the time, but anyway, there's a little bit in Govy, but there's more in TBF. What do we talk about with interest rates? Well, this is buying a laddered portfolio of coupon treasuries. This is shorting treasuries. So right now, the bias is toward the short side. There's a ton of cash at 38%. And as I mentioned in the newsletter, I mean, BTAL is this is sort of like saying the high octane, the high beta stocks. This does well when the high beta stocks do worse than the low beta. When the market gets more defensive, but it's a long short portfolio. I did not want a straight short in here because it can drag the returns. And then VIXI, which is kind of like hey, crush it in those sudden down markets. We don't have a sudden down market. We have a slow down market, and one that is still battling to try to buy the dips. So until that's extinguished, I'm not surprised that this is maybe more of a moderate position. Okay. So anyway, I won't go into that level of detail every week, but I wanted you to see, because it's a great live example. This is after you've created a portfolio, but you can create any of this you want. And then, of course, I put this out recently, but yeah, I think it's helpful. Okay, again, this is kind of an AOM benchmark, moderate risk portfolio with all the hedging in here. But as you can see, okay, it's holding up pretty well here during this period of time. And yes, this is live, live on the automated model. Okay. I think the automated model probably was a little later than I was with gold, but I mean, very close, very close. This has basically been my experience this year. This blue line, this has been my experience with my sort of core ETF investments. Frankly, even a lot of my trading accounts look like this. Okay, because everything's kind of going the same way. So whether you collar it, or whether you use ETFs, or whether you're trading stock short term or ETF short term, I mean, a lot of stuff's just ending up in the same way. But it's not ending up like this, where stocks and bonds fade together. There's obviously something going on here, in particular the last month. Okay. Now, this is not from just throwing all the money into cash. Otherwise, I'd be just about flat for the whole year. And instead, up 2.4%. My actual portfolio, I think I wrote this down. It's actually on the Pie Trade app. I did 3.5, something like that. So, but again, let's bring it all back to what are we doing here? Constructing portfolios. what does it take to construct a portfolio? Well, and I'll just do this for a second here because I've taken you through most. Let's go. And by the way, does anybody have a um, a portfolio, a simple one, let's say, that they'd like to try out live? If so, send it to me in the chat or use the microphone. I'm going to answer a couple of questions and we'll finish up with one example here. Any plans to expand the backtest window longer than 5 years? I think we actually went back 10 years. My question would be why? Um, I mean, I'm certainly not against it. You know, more data, the better, I guess. But here's the problem. I think that you get pre-pandemic era and different game. It's a different game. It's like, yeah, it's similar. Okay. On short notice, here's the best example I can give you, Matt, for asking a very good question. Uh, is Canadian football identical to American football, U.S. football? No, they're very similar. A lot of things similar. That's why players can play in both leagues. They're all different, though. Okay, and and in the same way, maybe a better example, baseball. Baseball today, not the same as when Babe Ruth played. Okay, it's and not just because of automated umpires and pitch clocks and home run celebrations that take 5 minutes and all that stuff. Okay, if you're a baseball fan, uh, it's different because there's been so much evolution, analytics in baseball and in investing. Decisions being made, this could be a good article, decisions being made in baseball and in investment markets based on analytics. Huge amounts of money being tossed around based on analytics. So if we go back to the glory days of the dot-com bubble or the 1990s, 80s, 70s when we had inflation the last time, okay, or even last decade or the financial crisis in 08, 09, we'll get data, but in my book, I think it might be more misleading than it's worth. And in the last 6.5 or 6 years and 3 months since the pandemic, we've had exogenous shock. We've had another exogenous shock in a little more slow motion if you think about Liberation Day. We've had a couple of smaller ones in between. We've had stocks and bonds going down at the same time for the first time since the 1970s, which means that if 5 years ago we had said, oh, let's go back to the 1990 to 2020, you would not have had any period in which stocks and bonds were precipitously falling at the same time because rates were going up and stock prices were going down. You also didn't have this narrow market. So for all of these reasons, I'm always up for more data. Personally, I think it's going to produce what they call paralysis by analysis because we'll be glomming on to what happened years ago. There are similarities today, right now, between the 87 crash and the dot-com bubble and the global financial crisis and even the pandemic and 2022 and even last year, and almost to the day, with the Tariff Liberation Day event. You take all of those together, and my conclusion is not, hey, let's pretend it's just like that and let's see what happened and then we can outsmart everybody. I know that's my mind used to go there all the time. Okay. Today, it's more about saying, let's account for almost any possible risk we can, and let's go into portfolio management, at least I do, no matter which one of your own you're creating, and say, okay, first things first. How am I playing offense? How am I playing defense? But even before that, what am I trying to do here? Am I trying to create, what's my goal? Okay. Am I trying to create a portfolio that will never lose more than 10% in any imaginable situation in the markets? And, you know, there's we've seen a lot of that. Not a lot of samples, but you can only have so much sample size, right? Because again, it just times change. Anyway, with that said, still very open. Let us know how much you think you'd like, and anybody else, if you'd like to have more history, go in, mess around with it for a while, build some things in here. Um, and by the way, it is as simple as, let me see here. Oh, good. I have a taker on this. Let me see here. Oh, a couple other questions. Then I'll do this one example, then we'll finish. Okay, Alex, thank you. So what we are seeing is that system calculates weekly ROR scores and adjusts the portfolio. Um, yes, the weekly route applies in a lot of cases, but not in all. And that's a great reminder to us that we do have to make sure that any portfolio that is done here, okay, is definitely a weekly. Now, remember, a lot of these portfolios, you can automate them entirely, but you don't have to. Okay. So, as an example, the ROR 10, I am trying to remember based on this one. I believe, yeah, this is, yeah, weekly rebalancing. Okay. How this portfolio works. So, I'm going to double check because, I'm part of the quality assurance team too, as you would imagine. And just make sure that in any version of this, if you go and you create your own, I want to make sure because I think in some cases you may have um, the option to have it run daily. I'm just looking here to see if it's there, and I do not know for sure. So we will check and we'll make sure it's right in the site. Just build it right in the site. Um, okay, let's see. Did QE change everything, Matt? Yeah, that's a much shorter QE and the pandemic changed everything. That's the short answer to what I was going off on before. I'm really ranty today. Sorry. Okay, so maybe because it's a busy writing day. All right, let's see. Jim says, "Wow, okay, testing my knowledge here. All right, I'm going to put in $100,000, and again, with absolutely no idea. Okay, militia long short equity. I have a feeling that doesn't have much of a track record, so that might mess this up. If it doesn't have a long track record, then ROR scores don't go back too far. But let's take a look. Or is one of the ones he put in. CGDV. I highly recommend writing this on a piece of scratch paper or something before you do this. Okay, Bill is going to be your default. If you get to the point where this doesn't fill and there's money left over, there's only one place it can go. But you can change this. If you say, no, I don't want cash as my reserve. I want to go in the Nasdaq. If none of these are good enough, then let the Nasdaq soak up the rest of it, or whatever. You put anything in there, okay? But this is important. But you'll see here, this is what's really important: the ticker stuff, okay? All right, let's see, VIXI. All right. So let's see what we have here. I believe that we have, I think I saw, look like a couple of hedged equity types here. All right. Now, and I'll just take this part over. I know that VIXI is very volatile. Okay. It's a volatility index. And I am going to give us here, let's see, let's go use it just so I can show you. That's how you override the benchmark right there. You can put anything in here. Your benchmark could be NVIDIA, IBM, any stock you want. So anyway, I believe these two are sort of hedged ETFs, maybe option oriented or long short. So I assume this is sort of the core of the portfolio, and this is the disaster protection. Okay, so I am going to start with this and say, all right, we look at for these portfolios, we don't look at an infinite number of ranges. It's basically if the ROR score is in the green zone, 70 or above, it would get the max weight. What's the max weight? Well, if you do nothing, it's going to fill in 80, 50, and 20 for the max, the neutral, and the minimum. This would be a yellow zone score. This would be a red zone score. And so let's do this. We've got a couple of these here, all right? And I don't know them too well. So I'm going to say, yeah, let's just go with these. Okay. I think I can just put this in, but just to be safe, I'm going to overwrite them here. And based on the Roar score, okay, it's going to run these. All right. By the way, we think the Roar score is great. Is it 100% of where I'd love it to be? 92%, I'll say. Because, it can get stay a little bit too long, not get in a little bit early, but that's the next round of fixes. Now that this stuff is done, I wouldn't call it a fix because it might not be better. It may be as good as it can possibly be because no system's perfect. But we are looking at that to try to make it maybe so that we can improve just a little bit at the edges in the whipsaw markets, because that has always been the toughest thing for any technical system. All right. We have to be careful with this one. I'm going to use my rule here where I want to at least have 1% of it. And if the market goes haywire, I'm going to have 3%. And I should say if the market is kind of neutral, or it's not really giving me a signal. And the maximum, because this thing can really get wild, I'll go up to 5%. All right. Now, keep in mind, if you can the other way to do this is something I figured out myself very recently. If you say, you know what, I really want to build around Orr here, okay? Kind of like the old Boston Bruins. I'm going to build around Orr, Bobby Orr, all right? I could go in here and say, I always want this to be 50% of the portfolio. Ta-da, 50%. Those of you who will remember, I used to have something called the 2ETF growth or Roar growth, I think we called it. I can't remember. And it said, take the Roar score, SPY Bill, but SPY is always at least 50%, and then apply the Roar score to the rest of the other. Okay. So this is kind of in that mold. You can fix this at 50% and let these two fight it out for the rest of it. Okay. It's actually, dare I say, some geeky fun to start doing the modeling with this stuff. Okay. And then some people will be like, forget it. Just, you guys do it. Anyway, you hit this, look how fast. Okay. All right. Kind of like in the old business. Oh yeah. Okay. You can see this one has been around. Okay. It's been around for a year. So that's enough. This is probably the inception of Orr. I'm not sure how long one's been around, but I think a little bit longer. Okay, so what did it do here? Well, it did a pretty nice job, you can see. Matter of fact, let's see, because we know what's happened this year. Okay, a little bit of a dip here. Oh, good. We are working on this. Thank you. I asked to put in any start date that you want here, and they just did it. Okay, I won't take any time with that today. I'll just kind of go to here. Let's see, when did this really start? All right, so you can stress test this, all right, versus any benchmark. Okay. The biggest issue here is not lack of features, it's a lot of features. And we may even get to the point with user feedback where people say, you know what, give me less to mess with here. Hone in on this, and this, because that's going to save me time or it's going to make it more. That's why we need people testing it, because I can handle the complexity and the infinite nature of this because it's been my whole career. So anyway, where does it lay out right now? Oh, Bill's 57%. Okay, and VIX's here. Fine, I can run historical analytics on it. And again, it's been a short period of time, but pretty good return, similar. So in this case, it's like much more return and similar drawdown compared to AOR, the 60/40. And again, it's only about a year or less than a year. Okay. It's caught just about 100% of the 60/40's ups and about 65% of this. And then it will also give you, this is the sort of, overall for the period that I think from inception. And this is just the period you picked. Some of this stuff literally I'm seeing for the first time. Okay. Whoa, I haven't seen this at all. Okay. Well, play around with it. All right. You get your Roar scores here. I'm a kid in a candy store, friends. Okay, risk reward. Okay, I mean, I knew all this was coming. I haven't even had a chance to look at it yet. That's how that's how quickly this stuff gets built. All right, I'm gonna do one more change, one more thing here. Okay, so it's defaulting. I just saw that this portfolio can be 57% bill. That's a lot of cash. Well, why is it 57% bill? Because I saw this was at 3%, and these two are at their lows. So you got 20 and 20, and 3 is 43. Yeah, the 57's got to be in bill. Well, I don't want that. Okay, good. Then one way to do it. Here, Jim, what do you want just send it in the chat. Give me a number. What do you want the maximum cash to be?
30%.
Okay, 30% max cash. Well, then I guess that means, I mean, look, this is going to be 1% here, right? So that plus the 30 minimum in cash. So these two have to be 69. So I'll just do it this way because again, all right, save the configuration and let me go back here. Oh, that's right. VIXI was 3. Okay. So it would have been 30% in bill, but VIXI is the only one of these that is not at the low. In fact, you can see it right here. You see, it all fits together. VIXI is in the yellow zone, and these two guys are in the red zone. Okay. I don't know what you guys think. We haven't thought carefully yet. We even thought about almost getting rid of the numbers and just saying, there's 3 conditions. Because look, I'm a technician and I look at lots of different things. Technically, there's 11 different Roar scores. It can go to 0, it can go to 100, it can go to 10, it can go to 90. That doesn't happen too often, very rare. Tails. 20 to 80 is where most of them are, but that's a lot of different iterations. That's why we came up with the color coding. Maybe consolidating that a little bit would be easier for the user. We've even thought about having a pro level where we don't take any of it out and a, let's call it DIY professional level where we just make it easier to use. But we don't know until you tell us. So I am going to stop there. It's been about an hour and a half. And just so you know, one of the reasons that we go a ways here, I'm amazed and thank you for hanging out this long with us. But I think if we want to, the reason sometimes that I get very long-winded with this, you probably figured it out. We record this and we get a 2-for-1. There's going to be instructional videos that come out of this that will go into the site, and you just happen to be here live for the recording of it. So there you go. All right. That is that. I can't believe it. I spent an hour and a half on this system. I guess I can believe it because I think it's really that good. And I thank the folks at PieTrade for even making it possible. And let me know what you guys think because, this is like a playground every Tuesday. I can go over the markets and then you can just fire questions at me and, we build portfolios together. I actually do own, last thing I'll tell you, I actually own a lot of URLs. One of them, buildaportfolio.com. Like Build-A-Bear, except with portfolios. So I've been thinking about it, and I've had that URL for like 10 years, but it's only now that I actually get to do it and have this really high powered modern analytic tool. So thank you for joining. Are there, oh, wait a minute, one more question. Let's see, do different tickers, I think you're asking, tickers says tickets, have different sensitivity to Rohr scores? Is Rohr more predictive for price movement for some tickers than others? Oh, question for next time. Well, I'll give you a very quick and straightforward answer. This system, as it stands right now, is doing exactly what it's supposed to do. And what do I mean by that? I mean that the the best thing that this does is when a ticker, and let me pull this up. There, I'll just put this in. SPY, good example. Very good example. So here's SPY so far for the year. All right, actually, I'll go back a full year. When you see something yellow, 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 yellow goes red, that is a powerful signal. Okay. Why? Because it's gotten the jitters out. Okay. This is a less powerful signal, which is why, again, it's not a day-to-day timing service. And these are even, I think, weekly. I think these numbers, the prices are daily, but these are changing weekly. We're trying to smooth it, but not over smooth it. So this is a good example. Okay. This, just get a little more time in here. Okay. This was a good example last February. All right. Once this bounce was over, I mean, that was it. That was it. Okay. That's, and again, though, this was 5% of it. This was telling you, hey, conditions are not great, but not terrible yet. And you have to decide what that means to you. Okay. We'd love to have a perfect timing system. I don't know if such a thing is possible. Okay. But I do know that when this gets droopy and it's yellow, 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 and it goes to red, it's going to take, I don't know, either a social post or something exogenous or something dramatic from the Fed, dropping interest rates, 1.5, I don't know, who knows. Okay. So that's what it's best for. The other way to test this out, I'll just do this very quickly. And again, your questions are helping me a lot to figure this out, okay? How well does it work for NVIDIA? Just to pick one stock that people have probably heard of. Well, what if I say the benchmark is, and again, this is just testing the system to do research, okay, and also to help us see if it works, okay? I'm all in NVIDIA when it's here, and I'm all in NVIDIA when it's here, but when it's not, I'm totally out of it. I don't think this is going to work that well, frankly, because it's not an all or nothing system. It's a portfolio system. But this is basically saying when NVIDIA's Rohr score is 40 to 60 or 70 to 100, so 40 and above, my portfolio is all NVIDIA. When it's not, then when it's red, I want out. So I've manufactured, if you will, a buy-sell system. How did it do? We go back a little bit further. Yep. See? I mean, sometimes it goes to red, and you're it could still be red. It's not a perfect system. It's going to manage risk. It's going to manage risk, I would think fairly well, like you can see here, that you can see when it's going to zero. And that's kind of an introduction to how you use this. That could be a whole session by itself. So a very good question, all really good questions. Thank you for hanging out and for learning. And you'll be the first ones to know that a lot of this stuff was recorded. So you'll a chance. And look, we need your feedback more than anything else right now. Not just about the technicals of the system, but what you want from us, right? We got ETF yourself. We got Aurora.pod trade. We've got not Rob managing money, but Rob providing research models to an RIA that is responsible for the money. You know, my old job, but in a different format and where I'm not a fiduciary. Um, you know, all kinds of possibilities here. And you guys that show up to this every week, you are like our inner circle. And, we'll have more for you on that pretty soon. But we welcome your ideas. And, if we don't have your email, info@sungardeninvestment.com, or get us through the ETF yourself, because this is a time where we can all build something really neat together, and you will have direct input, not just for yourselves, but for hopefully a lot of other people that are going to discover this. Thank you all. We'll see you next week.